Okay, welcome to Legacy Money. Hi, I'm Barry Page, and we are live at 5. Okay, welcome. This show shares the truth about money and how it really works. This show shares the truth about money and how it really works. Maybe that's a little better. We have a slight delay because we are webcasting via Zoom, so I can share my screen with you. Um, we've been broadcasting from the radio station a few times, but today we are live back in the office, and I appreciate you joining us. We'll be webcasting from now on, and that way you can catch this anytime, 24/7. We really appreciate you being here. And today I'm going to discuss infinite banking, my favorite subject. And you'll learn how you can use infinite banking in your life, your personal life, your own personal economy, and also how you can live more, give more, and leave more for your family, loved ones, and the causes that you care about. So bear with me. I'm going to switch screens now. And so I can share everything with you. Okay, hopefully you can see that okay. So we're going to talk about the infinite banking concept, and I'm really glad that you've joined us. Um, just a real question for you: who's really in control of your money? Have you ever thought about that? Is it the banks? Is it the government? Is it about interest rates? Well, my mentor, Nelson Nash, said learning to control it is the most profitable thing that you can do over a lifetime. So that's what this webcast is all about. Here's a quote from Henry Ford. It says, "It's well enough that the people of the nation do not understand our banking and monetary system. For if they did, I believe there'd be a revolution before tomorrow morning." You may have heard of Robert Kiyosaki, the author of Rich Dad Poor Dad. He said to control a car, the key is driver's education. With assets, the key is financial education. So if you haven't read his book, I highly recommend you read it, Rich Dad Poor Dad. You may have also heard of Warren Buffett. Now, many people think that they are diversifying by buying mutual funds and whatnot, but Buffett said diversification is required when investors do not understand what they're doing. So today, I want to share with you a real simple concept where you can understand how to take control of your money and how easily you can use it to finance your major purchases. You might also want to understand a little bit about the government and the tax policy. This is from David Walker. He says the current fiscal policy is unsustainable. We're heading to a future where we'll have to double federal taxes or cut federal spending by 60%. David Walker was the former Comptroller General of the United States. So basically, he was the accountant under Bush and Clinton. And he's now blowing the whistle on this outrageous spending that's going on. And it's all funded by taxes. It's a new idea where you plunder them just a little bit on a regular basis. It's called taxation. Banks. They love for us to deposit our money whether it be direct deposit, the drive-through. They take control of the money as soon as it's deposited in your account. And the bank rules are deposit your money with them as often as possible and leave it as long as possible. And they'll figure out a way to loan it back to you or loan it out to others. Banks use our money. That's really how they work. They use our money to loan out to other people. Now, there's nothing wrong with that. That's capitalism. But if you really understand what happens with that, it's called inflation. And that's not good for anybody because they use something called the fractional reserve system. So here's $1 million question for you. If what you thought to be true about your money turned out not to be true, when would you want to know? It's really the difference between tyranny and the truth. So I want to share the truth with you. And once you learn the truth, you can take the appropriate measures to protect yourself and your loved ones from financial tyranny. Here's some standard advice you've probably heard. Save money, get out of debt, invest for the long term, and diversify. Well, investors who follow this advice have lost trillions of dollars in the stock markets. Many of them have lost their entire retirement savings and had to return back to work. So I want to show you how to correct that. And if it works so well, why do you think so many people struggle when we live in the most prosperous country in the world? Yet, despite all the warnings, people still follow this advice. But it's not your fault. The banks and the financial institutions do a good job at confusing things. So I want to keep this real simple. I want to show you a way that you can take control of your money using the infinite banking concept. And you're probably going to ask yourself, if you haven't heard this already, why haven't you heard it before? Well, again, the banks don't want you to know. It's all based on the best-selling book from Nelson Nash, Becoming Your Own Banker. Nelson died this past year. He was a personal mentor of mine, and he will be truly missed. Here's me pictured with Nelson at the Infinite Banking Think Tank several years ago. I'll be at the think tank again next week. So if you'd like to learn more about that, you can at infinitebanking.org. So what is the infinite banking concept? It's an exercise in imagination, reason, logic, and prophecy. See, none of this is really new. It's been around since the beginning of time. As a matter of fact, there's verses throughout the Bible on money and banking and finance. And it really takes some imagination. That's why it's called infinite. But once you hear about it, once you learn how it works, your mind will really race with ways that you can use it. It's not get rich quick. It's not pie in the sky. It's not a sales gimmick. There are no upsells, and I'm not going to try to sell you anything on this webcast today. Okay, if you're just now joining us, we are broadcasting, webcasting through Zoom and YouTube, so you can view my screen as well as me. We're talking about the infinite banking concept, and it's a way to take control of your money. It takes time, it takes discipline, it takes commitment. And by the way, I will be answering questions in the future. Hopefully we'll get all the bugs worked out. This is the first time back live in the office studio. So still trying to work out the bugs, and I'll have some help going forward to answer the chat and your questions. So if you do have questions though, feel free to just comment on the video, and I'll answer them there on YouTube in the future. But for today, I'm going to hold off on questions. I may take a few at the end if we get through this in time. So we're talking about the infinite banking concept, and the whole idea is to recapture the interest that one is paying to banks and finance companies for the major items that we need during our lifetime. Things such as automobiles, major appliances, education, homes, investment opportunities, business equipment, etc. That's direct from Nelson Nash, the author of Becoming Your Own Banker. And I can tell you personally that I've used it for just about all of those things. My kids are in college, going to college this year, next year, and I've purchased automobiles. I've used it in my business, and it's a great way to utilize your money. So it's also a predictable way to grow your wealth. It's an alternative to traditional investing. Now, that doesn't mean that you have to use it over traditional investing. You can use it and do traditional investing. We recommend that you run your money through your own personal system first, but it's really up to you. You can just look at it as an alternative, as an and asset, or along a standalone way to plan your financial future without the risk and worry of investing in the market or other plans. So imagine, if you will, never having to depend on banks for money ever again. I mean, no bank qualifying, no bank rules, and having access to capital for opportunities, business investments, real estate, whatever comes your way, you can utilize your private system to finance these items. How about giving more to your church, your causes, and to leave a legacy for your family and those you love? It's a way to protect your family and business from wealth transfers without the cost and fees of hiring accountants and lawyers. This is simple. It's something that anyone can do on their own. And if you do, you're able to recover things like taxes, interest, and fees that you would normally transfer away. It's a way to finance your major purchases through your own bank without depending on traditional banks or financial institutions for money. It's a way that you can erase your bad debt and turn it into generational wealth for your family or others, eliminating the need for credit reporting that traditional banks and financial institutions use to qualify you for loans. How does it work? Well, it works through a custom designed participating whole life insurance policy. This isn't your off the shelf life insurance policy. It's a specially designed contract. And 99% of life insurance agents know nothing about it because their companies don't want them to know, and because the banks and the government don't want you to know. We use it to recapture interest and fees that we now pay to others through deposits and loans through your own bank. Now, bank is a generic term. It's used just as a metaphor, a simile, whatever you want to call it, it works just like a normal bank, but it's your private banking system. So banking is a verb. We're using it as a verb. It's just a process that we go through. It allows you to access capital at any time without penalty. Now compare that to a traditional place you might have stored your money, or maybe a retirement plan, a qualified retirement plan, or really any other investment that you may have to lock your money up for a period of time. What it does is allow you to actually use your life insurance policy while you're alive, so you can spend it. See, most people want to look at life insurance for dying, and nobody really wants to think about that. So we want to show you a way that you can use your life insurance while you're alive. So why should you listen to me? Well, after a life of hard knocks and many years as a financial advisor, I've realized that traditional financial planning does not work, and there is a better way. My business, my practice is solely based on infinite banking today. This is what I teach all of my clients. It's what I practice myself, and you can use it in your life. It's time tested and proven. It's really nothing new. It's been used by it's used by most all the major corporations and the banks, but some of the ones you're probably familiar of, J.C. Penney, Walt Disney, McDonald's, the Pampered Chef, all of the federal banks use it, or Federal Reserve banks use what's, I'll show you here in a minute, but they all utilize life insurance, and you can too. So the very first principle that you must understand is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. Now, this is something that's hard for most people to get their arms around, because when they pay cash for something, they don't always realize that they're giving up the opportunity for that cash to earn interest, right? So your capital, your money, has a cost. And the problem is that all of these items are financed by other banking institutions. And that means the interest portion of every dollar that's spent is perpetual. It's gone forever. Once you spend it on interest, that money is gone. So the volume of interest is the real issue. It's not about the annual percentage rate. So this is what, again, causes many people to have a little confusion here, because, for instance, today, the Federal Reserve met again. They usually meet on Wednesdays once a month, and they determine what's the interest rate. So people watch that closely. That's how banks determine what they're going to loan money at. And, so everybody has their eyes on interest rates, but this isn't about rates. It's about the volume of interest that we're paying or giving up the ability to earn over our lifetime. And that amount is huge. So here's the annual pattern of spending for most people. Now, this is directly out of the book, Becoming Your Own Banker. So if you'll notice here, the green line is the payment that we make for automobiles, housing, living, saving. And let's just say 20% of our income is going towards automobiles. That's the average American. About 30% goes towards housing. This is the rent or the mortgage. And other living expenses is the largest. That's everything that it costs us for our lifestyle to live. And then our saving, as you see there, is at 10%. That's being very generous. Most Americans are saving less than 10%. But what I want you to note is the red lines. So the red lines are the interest. And if you add all the red lines up, about 5% for autos, about 25% for housing, and about 5% for living, then you get about 30%. So right off the bat, just think about that. That's a 3-to-1 ratio. And again, we're being very generous, assuming that somebody is saving 10%, which in reality, most people save less. If you're saving 10%, that's great. We actually recommend that you save 20% of your gross income. And so you can use this while you're saving in other accounts, or standalone, or, together. So that's where our money goes, a traditional family. And again, this is right out of the book, Becoming Your Own Banker. So I want to compare this for you here and just kind of give you a little idea. This is, again, an example that Nelson Nash liked to use. He was a pilot for a while, and he wanted to compare this to something that most people could maybe understand. So let's say you're in an airplane and that airspeed of that plane is 300 miles per hour. Maybe you've been in a plane before flying, and the pilot comes over the intercom and he says, we've got a little bit of a headwind. So we're going to be arriving 30 minutes late. And so in this example, let's say that headwind is 100 miles per hour. So if the airspeed was 300 miles per hour, you have a headwind of 100 miles per hour. Well, now the plane's moving forward at 200 miles per hour. You with me so far? So let's take the opposite of that. Maybe you're flying back to your destination and you've got a tailwind, and the pilot says we're going to get there a little early. Well, 100-mile-per-hour tailwind added to the 300-mile-per-hour airspeed, and you have a total of 400 miles per hour. Now, you might think, well, that's great. And so let's relate the debt to the headwind. Okay. So in this case, if we're spending 30% on interest, or and we're saving 10%. Okay. So the reverse here maybe, but you get the picture. Okay. So you might think, well, okay, if I get rid of the headwind and I get a tailwind, that's great. But in reality, here's what's happening. You're actually going twice as fast, 400 miles per hour versus 200 miles per hour. Okay. So you've doubled your airspeed. You're going twice as fast. You're saving twice as much because you're eliminating the debt and the paying of interest to others. Well, there's more problems. Taxes. Now, what I have here in front of you is the history of taxes. Would you believe that people have paid as much as 94% in income taxes? Now, these are the highest marginal brackets, and they do change. They changed just this past year with the tax cuts. Okay. So these brackets adjust as well. But when you look at it over time, and if you actually looked at the average of taxes over time, now today we're over here, the highest marginal bracket is 39%. But again, it's all relative. So here's kind of the history of taxes. So taxes were created by the IRS in 1913. Now, ironically, that was the same year that the Federal Reserve was created. So it wasn't a very good year for our country. Then we had the stock market crash. Social Security was created in 1935. Look at the huge spike in taxes right there. Okay. So Social Security was run along here, and then LBJ created Medicare right here, this spike. Okay. This is when Ronald Reagan was an actor. He was making roughly $1 million on a movie, and he was being taxed at 90%. So he's bringing home $100,000 after taxes. So he decided only to make 2 movies per year. I mean, why would you want to make any more than that if you're going to be taxed to death? So this is something that the politicians just can't seem to understand, is that if people continue to be taxed, and there's going to be less money in the system. So these are the tax breaks right here when Ronald Reagan was president. Here's the first Bush, read my lips, I won't raise taxes. Here's Clinton, and the second Bush, and here's Obama, and here's where we are today. All right. So if you look at that, if you kind of fast forward, so we had the Tax Cut and Jobs Act in 2017. This past year and today, we have $123 trillion of unfunded liabilities. That's debt to you and me, taxes. And you have some of these politicians, talking about Medicare for all, free college for all. Just ask yourself, where will that money come from? Where does the government get money? So here's some human factors that we have to get over if we're going to really understand this concept. The first one is the arrival syndrome. And that is, I already know everything, so there's no point in trying to teach me something new. Again, this is right out of the book, Becoming Your Own Banker. Will Rogers said, the problem in America is not what people know, it's what they think they know that just ain't so. And Malcolm Forbes said, the dumbest people I know are those that know it all. Private banking, infinite banking, is the solution to all of this. Banking is the most important business in the world. And if we'll just learn how to control our finances, then we can earn profits just like the banks do. All right, so let's look at how we make purchases. The debtor has no savings and they earn no interest, so they just pay interest to others. They have tailwind and that's it. Or I'm sorry, a headwind and that's it. The saver saves money and he earns interest on his money, but then he pays cash for his purchases, which sounds like a good idea. There's no headwind, there's no tailwind. But the wealth creator saves money and he compounds his interest and then he collateralizes his purchases. This is very important because it allows for uninterrupted compounding whenever we borrow money. When we use the capital in our own banking system, it continues to grow. So here's what it looks like. The debtor, again, borrows money and then he pays the money back monthly or annually, however he might do it. Borrows money again, pays it back, and he's back to ground zero every time. Borrows money, pays it back. Borrows money, pays it back, right? So each time he gets back to ground zero. The saver, on the other hand, saves money, right? Maybe monthly, maybe annually, and he fills up his tank, his money, and then he pays cash for his purchases. So as you see here, he's back to ground zero. His money is no longer working for him because he's spent it on his purchase, right? He saves money again though, and then he spends it to buy another car, pay for college, the appliance that broke, whatever might happen, the emergencies in life. Maybe it's an opportunity, maybe it's an investment, who knows? But it's hard to get ahead because he's actually stunning the growth of his money. So what we advocate is becoming a wealth creator and collateralizing our purchases. So it works the same way. We have to save money, right? And then we use the money, but the money continues to compound. And then we pay back into our own system versus paying someone else interest. We can use the money again. And so in this circumstance, just consider that these are automobile purchases. So every 4 or 5 years, we use the money. The money continues to compound even though we're using it, right? And then eventually the money is growing faster. So the plan becomes self-sufficient. And we'll get into that in a little more detail. But just understand now that there's 3 ways to purchase items. You can either just borrow outright, you can save and pay cash, or you can become the wealth creator and collateralize your purchases. So you finance everything that you buy. Banking is a process. It's not about a product. People want to get caught up in the fact that we're utilizing life insurance. But again, this is a specially designed contract and it's a process that we're utilizing. Okay. It's not about the rates. It's not about the product. It's a process. So banks understand the velocity of money. They like loaning money over and over again. It's called the velocity of money. And that's what I'd like for you to understand so you can start using this in your life. So what is EVA? It stands for Economic Value Added. It's a trademark term of Stern, Stewart and Company. It's used to measure the financial performance that attempts to capture the true economic profit of operating decisions. It's calculated by deducting the cost of capital from after-tax operating profits. So why is that important? Well, as I said earlier, your capital has a cost. So when considering your personal economy, the consumption cost of existing capital should be highly valued because once you spend $1, that dollar is gone forever. So that's why we recommend running all of our capital through our own system so we can take advantage of the uninterrupted compounding. So I said it's specific kind of life insurance. Well, what kind? Excuse me there, my mouth is dry. So it's a dividend paying whole life insurance contract from a mutual company. Very big difference there. That term mutual company. There's really two types of life insurance companies. There's stock-based companies and there's mutual companies. So stock-based means that their obligation, their fiduciary responsibility is to their stockholders, right? Mutual companies, on the other hand, are not publicly traded. They're owned by their policyholders. So these companies pay dividends. The dividends are not guaranteed, but all of the companies, the carriers that we use, have paid dividends for over 100 years. So they've got a track record that's proven, and their whole goal, their fiducial responsibility, is to their policy holders. Okay. There's only a handful of mutual companies where there's thousands of stock based companies. These companies, these policies, excuse me, are custom built for you. We design them based on your wants and your needs. You can't buy them off the shelf, and you can't get them from the average life insurance agent. Again, most agents don't have a clue about this. So just by watching this training, this show today, you're going to know more than 95% of the life insurance agents out there. These plans can be self-completing. So if something happens to you, if you become disabled, if you need medical care, you get critically ill, if you die, these plans are self-completing as long as they're set up correctly. So again, you need somebody that understands this, an infinite banking practitioner. They're also flexible. So you can adjust, make changes as you go, depending on what happens in your life, and your life will change. So again, here's kind of the difference between mutual and stock companies. Private mutual companies are owned by policyholders and they pay dividends to the policyholders. Public companies are owned by stockholders and they pay dividends to the stockholders. So it's really, when you look at it, banks versus insurance companies. And banks work on something called the Federal Reserve System. They use fractional reserves, meaning that they can loan out more money than they have on hand. And this causes inflation, tyranny, and serfdom. On the other hand, infinite banking is a private family system that you can utilize for anything that you want at any time for any reason without bank qualifying. Life insurance companies have, and you would have 100% reserves in this instance. And it really creates financial freedom for you to do what you want, when you want with your capital. It is the truth. And it's something that you can practice, just learning how. But here's the dirty little secret that the banks don't want you to know. See, banks own more life insurance than anyone. They would never tell you this. It's called BOLI. And this chart here is a partial list compiled from the Pirates of Manhattan book written several years ago, probably about 10 years ago now. So these numbers are much larger now than they were then. But just get your arms around this. This is $13 billion worth of cash value life insurance owned by Bank of America. And again, this list is old, and you can see most of the major banks there: JP Morgan Chase, Citibank, Regions, and Bancorp South here in the South where we are. They all own BOLI. Again, these numbers are outdated, so those numbers are much larger now. You can even go to the FDIC website, the Federal Deposit Insurance Corporation, and you'll see that bank-owned life insurance is recommended for comprehensive risk management, okay, for purchasing bank-owned life insurance. So the FDIC recommends it. All of the big banks, the big corporations utilize it. So you can too. This is from the Office of the Comptroller General of the Currency, the U.S. Department of the Treasury. Again, as you see, bank-owned life insurance, national banks may purchase and hold certain types of life insurance, and they use it for their tier one capital. So the reserves that they have are actually held in life insurance. Why? Because it's safe. Why life insurance? Well, life insurance is predictable, it's sound, and it allows you to get multiple uses of your money. That's why I have a Swiss Army knife here. So if you were going camping and you could only have one tool to carry with you, most people would choose a Swiss Army knife. It's a multi-tool, right? That's what life insurance is. It allows your dollars to work harder. You can have multiple uses of every dollar. Whole life insurance is really the cornerstone of your financial plan. Without it, all else can fail. It's the only financial product that can stand completely on its own. It's been used, it's time tested and proven by Walt Disney. He used it to fund Disneyland, which you may have visited, you may be aware of. J.C. Penney rebounded after he was nearly wiped out in the late 20s when the stock market crashed. He used it to keep J.C. Penney afloat. If only he were around today, maybe he could help them today with their financial problems. But let's talk a little more because sometimes people want to get caught up in the rate. So I just want to kind of give you a comparison. Up here on the screen, I have a spreadsheet basically that shows you compounding. Now, over here on the left is a compounding rate of return. If somebody started out with $100,000 and they earned 5%, at the end of the year, they'd have $105,000. Now, the next year, if they earn 5%, they'd have a little more than the 110 because it's compounding, right? So not only do you get the 5,000, you get the 5% of 105,000. All right. So this column is the 5%, and this is the end of the year balance. After 10 years, you'd have 162,000. Now over here is speculation. So yes, you may be able to earn 12% in the stock market, but you could also lose money in the stock market. So in this example, just using round numbers, 12% every other year mostly, and a flat year here in the middle, and only a negative 6% loss, right? So if you just take this first example, so 12%, you have 112,000, right? So you're ahead in this situation. But the second year, you lost only 6%. So you're at 105. So you're actually behind here. All right. Now, as time goes on, this column collected 122. So the difference after those 10 years is $40,000 in plus of just a simple 5% return. So that's the difference between compounding at a guaranteed rate and speculation at a non-guaranteed rate. There's risk involved. Now, let's look at the cost of paying cash. Now, earlier I showed you an example of what would happen if you borrowed money. And here, I just want you to consider, this is that ladder that I was showing you for the saver, right? So if somebody just had $25,000 that they were going to contribute, and then they were going to take money out, drain the tank per se, to buy a vehicle or whatever they might purchase. What this shows is over 30 years, if you did that every 5 years, okay, and you did it 4 times, say you bought a vehicle, an automobile, and you saved up the money and you just paid cash, you didn't finance it, you paid cash from your savings. What it shows you is that over 30 years, that the difference would be $1.1 million. You would have delayed $337,000 of growth. And so the long-term difference is a 1.1 million. Now, let me show you another way to look at it. How would you like to pay for it? Would you rather Compound or amortize interest? In other words, would you rather have your money working or would you rather just pay interest to someone else? All right. So here's the same $25,000 and it's earning, let's say 6% in this case. So that number is going to be important. I'm going to show you here in a minute. It really, the rates don't matter, but I just want to use this as an example to help you get your arm around it. I'm going to use the same number here in a minute. So 6%, the interest earned on that $25,000 over 5 years, your final balance would be 33,721. Okay. Now, what if you had $25,000 that you borrowed at 6% and you were making a monthly payment? That payment would be $483. And your total cost of ownership at the end of 5 years would be 33,721. If you look, that number's the same. It's exactly the same. Now you might say, well, how can that be? Well, you again can have your money compounding or you can pay interest to someone else, right? But even if you were paying interest, what matters here is that the reason there's three colors here is because there's a lost opportunity cost in there as well. Okay, it's what your dollars could have earned had they not been used to pay interest, right? So that is compounding as well. Here's another way to look at it. This is just 4%. Now, I want to show you that because that's typically about what you can expect of a life insurance policy to grow internally over time. And every company, every carrier, every policy is a little different. It really depends on how you treat it. But just to help you get your arms around things, I want to show you that in this scenario at 4%, that 25,000 would have grown over 5 years to 30,000. Had you borrowed 25,000 and you take into account all of the factors, the cost of ownership, the total amount, then that is 30,525 as well. So the numbers are exactly the same. Here's why automobile manufacturers love financing, right? You notice all of the car manufacturers, they offer financing, whether it be Ford, General Motors, Toyota, it doesn't matter. Honda, they all offer financing. Do you think they make more money on the automobiles or the financing? It's on the financing, okay? So when you see these 2% rates or 0% rates, trust me, they're making money. And they do that by charging you more for the vehicle. That's why sometimes you'll see you can get a cash price or a finance cost, okay? And if you look at that example that I gave you earlier, where the interest on that loan was roughly $39.99, okay, per year, compounded at the 6%. That's about the average rate for an automobile purchase if you just went to a normal bank, traditional financing that has been for years. It fluctuates, and obviously rates are low today. But just using that number, what I want you to take note of here is that your second purchase, that $39.99 would have compounded, it would be at $55.32. Over 10 years, $71.62, right? So over time, if you just finance vehicles over your lifetime, okay, you traded them in, you got another vehicle, you traded it in, you got another vehicle, the total cost would be $275,000 over that time. So again, this is why car makers like financing. And just imagine recovering that money and having that money go back into your own system. Now, last week we spoke about college costs. And again, this is a example that you can use for college. And that cost, if you remember, the total cost for sending two kids to college was about $375,000, right? But the cost that the total cost, had you taken that money out of another account that was earning interest, that total cost with the lost opportunity was about $750,000. So again, if you just add those two together, you're looking at over $1 million that you could recover just in interest. All right, so how does the actual policy look? Well, let me show you. So in this example, I'm only going to show you financing one car, but again, in that last screen, you'll realize that over time, this adds up to some really big numbers. Okay, so this is what a policy looks like. And the premiums you can consider deposits going into your system, right? And the age really doesn't matter. In this example, the person was 30 years old when we started, but it really doesn't matter. You could be 50, you could be, excuse me, you could be 60, you could be 20, it could be a child, a juvenile. It's most important though, just to look at a parent first, and then you can, talk about the children later. But in this scenario, again, age 30. The premium is in this column. The cash value is in this column. And the cash value, what I want you to see here, the first year you put in 10,000, and immediately after the first year, you'd have 6,300, depending on how you paid monthly or annually, is available. Okay. The next year you'll notice 13,000, 21,000, and then 31,000. Whoops, here in this line. It's a little hard to see, but that should be grayed out a little bit for you there. So after 4 years, you put in 40, and you now have 31,252 available. So at this point, we're going to borrow 25,000, and we're going to pay back the repayment. And again, we're borrowing against the policy. We're borrowing actually against this death benefit here. It's a lien. So what this does, it allows the cash value to continue to grow. So if you notice here, you took out 25,000, but still the next year, the policy, the cash value grew to 41,000. So basically every penny that you put in, the 10,000, is available for loan the next year or for surrender, which I wouldn't recommend you did it that way, but that's what would be available. Okay. So you see it still grew even though money was taken out. Now, why does that happen? Because it's what it is. It's a lien. We've collateralized the policy. The money didn't actually come out of the policy. It would come from the death benefit should you die, right? So if the death benefit in this scenario was 501,000, you took out a $25,000 loan and you died right away, then your family would still get the death benefit, but it would be 476,000, the 501 minus the $25,000 loan you just had. Okay. So pretty simple to understand. And then as you see here, the policy is continuing to grow every year. Over here, we're repaying the loan just like we would repay a bank or a financial institution. The difference is the money is going back into your system so you can use it again. And I just used a nice figure here, nice round $500 a month, $6,000 a year. And if any additional money over the interest, and this is simple interest, so I don't really want to get into the weeds too deep here. Just understand that the money is going back into the system, the banking system that you've created for yourself using life insurance. Now, if you never use this again, then again, you would just recover the money that you are now paying to the bank. Okay. And where's that screen? Right here. So roughly the interest about $4,000 at 6% would have been paid to interest in that scenario. Okay. But over time, you see those numbers get much larger and as time goes on. And the problem here also is most people never get their car paid off before they refinance another one. So the numbers are actually much worse than this. All right. Hopefully you're with me. At year 10, what we've done is dropped the rider off the policy. We'll talk about that later. But basically, the base premium at that point is now $34.77. So it's been reduced. This person would now be 41 years of age, and they put in $34.77. The policy grew to 100 from 111 to 119. Okay, So that's a pretty nice growth based on what you've contributed or somebody may have contributed at that point. You also will notice that the death benefit, look how much it's growing. So in year 11, the death benefit has now grown to $726,000. In this case, the loan would have been paid off. You could do that again right here. In this case, you could borrow up to 89,873 from the policy. So maybe you wanted to get another car, maybe you had college to pay for, whatever it might be. All right. So at the end of 20 years, this person would now be 50 years old, and the policy cash values are now $205,000. Okay. So in that case, they would have put roughly $134,700 into the policy, and the cash value was $205,000 with the death benefit of $826,000. I don't know where else you could get that kind of return, or where you could use your money at the same time. Not to mention the death benefit. So that's how you could finance a car and have your money continue to work. Let's look, and we'll close up here shortly. I don't want to take too much time, but here's an example of banking during retirement. So in this scenario, we'll assume that somebody has saved $1 million in their IRA, 401k, or other qualified retirement plan. Okay. And we'll assume that same person, maybe their twin brother, had saved $750,000 into a permanent life insurance contract, an IBC infinite banking type plan. Now, I'm giving this person more money because people always have the argument, well, I can get a higher return in my mutual fund inside my qualified plan. Maybe you can. I don't know. But again, there's a lot of risk involved to get that higher return. So in this example, we'll just say that this private account has 750,000 and the qualified plan has $1 million. All right. So what we want to do now, let's imagine that we're 65 years old and we're going to take income for retirement. Okay. So using the 4% rule, if you're not familiar with that, just Google it. You can look it up. But it was a rule that was, it was in Morningstar. William Fowle, a famous economist, wrote this report, and they determined using what's called Monte Carlo that you could take 4% out of your account without running out of money. Now, this was about 20 years ago, I believe, when this rule came about. Today, the rule is about 2.6 because we're in a low interest rate environment. So I'm not telling you could take 4% out, but I'm just using that number because that's what most people are familiar with, whether they know where it came from or not. Okay. So, but in reality, that number today is based on 2.6. Okay. So over the last 30 years, I think the average is about 3.1. But I'm going to be very generous and we'll call it 4%. So what is 4% of $1 million? Well, that's $40,000 a year. Okay. So people oftentimes are kind of thrown back when I show them that, or when they find out that with $1 million, they can only take $40,000. And that's because you still, even at 4%, there's a risk you could run out of money. The market, just depending on when it is, something we call the sequence of returns, could cause you to run out of money. So $40,000 is the amount. Now you got to pay taxes because this is a qualified plan. So you deferred taxes going in, you postponed them. Now you're retired, you've got to pay taxes on the money coming out. So the net income that year is $34,000. Okay. Plus any other income you may have and Social Security. Now, Social Security will likely be taxable because in this case, for instance, you add your Social Security to your income, depending on if you're married or single at that time, or if you have other income, that's going to determine how much your Social Security is taxed. Okay. So it could be taxed as much as 85% of your Social Security income could be taxed. Okay. So it could be 50%, just depending on your thresholds, but it will be taxed in most cases, especially if you're single, if you're married, even just depends on your income, your provisional income, your threshold income. All right. So, but not counting Social Security, the net income was $34,000. Now let's look at what would happen had you had that money in a permanent life insurance contract, practicing infinite banking. So the 750,000, you would be able to take out $45,000 a year of cash flow. Now, this could be adjusted more or less, just depending on where you are in life, how much income you might need. But that would be a safe withdrawal that would last you through mortality. Okay. So again, every situation is a little different depending on when you set the policy up, the contract, when you took the money out, and any number of factors. But in this scenario, we're using age 65, and we're playing it real safe with a $45,000 a year cash flow. There would be zero taxes payable on this money because this money would be taken as a loan against the death benefit, right? So if the death benefit were 750,000, you took out 45,000, then the death benefit would now be 705,000 should you die. Okay. Now there would be interest, but at this point the contract would be paying dividends, and that's what we're counting on to possibly pay the interest, or maybe not. It just depends on what you wanted to do at that time. But what I want you to notice here is this is a $45,000 net income versus $34,000. And this is 45,000 coming out of 750,000 versus 34,000 coming out of $1 million taxable. Which would you rather have? And if you're collecting Social Security, this is going to be non-taxable because this money, this cash flow, is non-taxable, and it's not going to cause a drain on your Social Security. So you could collect 100% of your Social Security income if you had no other income other than your IBC plan. Now, if you had other assets, maybe you did have an IRA, maybe you had an annuity, or maybe you had bonds, whatever it may be, your Social Security income could be taxed. So that's just a quick example of how IBC can be used during retirement. So that's really about it. The last thing that I want to talk about is legacy and stewardship. You may have heard the quote by Benjamin Franklin: certainty, in this world, nothing is certain but death and taxes. You see, at some point, my friends, all of us are going to die. And at that point, the death benefit, should you have an IBC contract, policy, plan, it would be paid to your heirs. And depending on how you treated your banking, your IBC policy, and how old you are, it would likely be close to double whatever the cash value was at that time, or at least equal to what you started with. So if you started out in the scenario that I showed you before, with a $387,000 death benefit, and you were taking loans for income, you would still have roughly probably that same amount. Okay. So the good thing is you can teach your children. You would have an obligation now that you learn this and use this to teach it to your children and your grandchildren. So you can practice stewardship and you can control your money even from the grave and keep it in the family instead of giving it to the banks, the government, and the hospitals. So I hope you enjoyed the show today. Again, we are broadcasting. This is live from our studio in Ocean Springs, Mississippi. I service clients throughout the Southeast, and if you have any questions or answers, I will see if I can get back uh, to my main screen here and possibly answer any questions that you might have. Okay. I don't see any. You can put them in the chat window. I do want to show you this, is being recorded, so you can access it as well. If you would like to go to our website, please visit us there. And if you'd like to learn more about IBC, this is what it would look like: legacyinsuranceagency.com/IBC. And you can schedule a meeting there. There's no cost, there's no obligation. And I'll meet with you and you can determine if this might be right for you. We can plug your numbers in. We, just want to be able to help you and teach you about this very, very important concept. So I don't see any questions, and I'm going to go ahead then and just wrap up the meeting. If you're watching this via recording, you can put your comments below, and I'll be glad to answer them there. Again, I want to thank you for your time, and if I can help you in any way, just go to legacyinsuranceagency.com, and you can schedule a meeting, you can ask questions, and I look forward to meeting you and hosting the show again next week. We're live Wednesdays at 5 p.m. Central Time, live at 5, Legacy Money, where we share with you how you can live more, give more, and leave more. So thank you for your time. I'll talk to you next time. Take care.